Hi, I'm Chip Stites, and this is The Laughing Retirement. Today, the topic we're going to talk about is the banking crisis. Now, do I own banks in my portfolio? Yes, I do. I tend to own regional banks at a minimum in size, not small banks. And I tend to own banks which have a history of paying dividends and a lower amount of risk to them. Do I think that any of the bank or banks that I own are going to go under? No, I do not. Do I think or know that this banking crisis is over? No, I do not. I don't know. I don't know if it's over. But I can tell you one thing. The crisis in these banks is related to the Fed raising rates. Why is that? Well, in 2008, with the crisis, DoddFrank wanted to make sure that banks were more secure. And so they gave examples of or controls to what banks could put their assets in. Because remember, a bank takes in your money and turns around and lends your money to someone else and takes the profits between the two, what they pay you and what they get on a loan, for themselves. Now, in order to maintain their assets, they have to have a certain amount of liquidity. And this liquidity has to be available to them instantly, as in US Treasuries. So one of the things that banks do in order to maintain their liquidity, in order to put their assets in a safe place, is to buy US Treasuries. That works very well until the Fed begins to raise rates. Now, what happens to a bond when rates go up? The rate goes up, the value of the bond goes down. It's a pretty simple equation. So back in 2012 or 2013 or 2014, if I'm a banker, and in order to secure my assets, to have safe assets, as I have to do, I bought US Treasuries, and I let those Treasuries sit there earning their income, small though it may be. When the Fed began raising rates, the value of my assets dropped as the rates went up. Now, according to the law, the bank has to keep so much assets available and on hand against so much liability, or the loans, the money that they put out. Assets versus liabilities. So as rates went up, the value of their assets dropped. When the value of their assets dropped, they've got a problem, because solvency has to do with assets versus liabilities. So we had some banks that were so close in what they had to have, assets versus liabilities, that when the value of their assets dropped and the liabilities rose, they became insolvent. And when the word got out that they were insolvent, what does a customer do? A customer runs to the bank, and there's a run on the bank, and the bank has to have the cash in order to give the customer, and these banks didn't have the cash. An insolvent bank. Now, did the people who could not get their money out, did they lose money? No, because we also have something called the Federal Deposit Insurance Corporation, known as the FDIC. The FDIC promises to pay them their money back, up to $250,000. So if you have a $250,000 less account, you're going to get your money back. If it's over $250,000, Bob is no longer your uncle, and you're not likely to get anything over $250 back. Now, during the banking crisis, did they change the rules? so that you could get more money back? Yes, they did. So if you have more than $250,000 in an account, you need to take the overage to another bank so that you're covered. It's not anymore, unfortunately, terribly wise to have a tremendous amount of cash in a bank, and especially when interest rates are going up. You're going to get paid a little bit more, but at the same time, you're losing purchasing power. In a time of inflation, the reason they're raising the rates is because we have high inflation. And so you're losing purchasing power in a place where you're paid almost nothing. Now, is this likely to happen again? It's highly possible if the Fed sees the need to raise rates. Now, currently, they have signaled that they are not going to raise rates again the next time around, depending. It's a nice way of saying we don't think we are, but we might. We don't want to, we may have to. Fed speak for, well, listen, whatever happens, happens. What would I do if I were you? Well, the first thing I would do is make sure I didn't have an account that had more than $250,000 in it. That's number one. Second thing I would do, if I own banks in my portfolio, is I would make sure they are larger, well-known names. Regional banks at a minimum, large regional banks at a minimum. How do you tell that? You can tell how large they are by just looking at their balance sheet. Look at their assets. In other words, if I had a bank, a small bank, and let's say the Akron, Ohio Community Bank versus US Bank, my bank, which would I rather own? Right now, under these conditions, US Bank. You see, size does make a difference. And the banks that went under were well-known banks in their area, but they certainly weren't large regional banks that people in 40, 50, 60 states did business in. They were focused banks. In one case, focused on Silicon Valley and Silicon Valley startups. Risky. So if I were you, I would make sure in my portfolio that the banks that I owned were not small community or very small regional banks, that they were large, well-known national banks or large regional banks. That would be my choice. I also wouldn't have more than $250,000 in any account for any reason in any one bank. Is this over? I don't know. If the Fed continues to raise rates, I would say it's not over. If the Fed stops raising rates and inflation does come down, it may be over. But as in all things, no one can predict the future. And the best thing for you to do is not to take substantial risk to begin with, and not to buy anything that doesn't pay you for the risk you take. I'm Chip Stites, founder and creator of The Laughing Retirement. If you're very concerned about your portfolio and you got a ton of banks in it, you might want to make some changes. Also, join the Laughing Retirement community on Facebook. We have some links below that you can follow. And we'd like you to follow us on YouTube. I'm Chip Stites, founder and creator of The Laughing Retirement. I hope this helped you. Bye.